into the investment questions, I want to talk a little bit about you.
You do?
Yes.
Okay.
I want to talk about how you got started, why you went into asset management, your experience at Fidelity, how you made the decision to become an entrepreneur. Lay it out for us.
So I was interested in the investment business from the time I was very young. I worked at Merrill Lynch when I was in high school. I just caught the bug. I really thought investing was fantastic. When I got out of college, I worked for an investment company. I went to business school. I got a job at Fidelity. And Fidelity was an unbelievable place where you were taught by the best people in the world. And I was lucky enough to have spent a year just working with Peter Lynch as an assistant fund manager on Magellan Fund. I traveled all around the world and looked at tons of companies, and then I followed many industries. I had 4 kids along the way. I managed a big growth fund for many years, and then I had an idea that I wanted to start a company and help other people get to know the clients. When you manage a fund at a big mutual fund company, you don't know your clients. So starting Aureus gave me and my partner I started with an opportunity, and we came from different companies, but it was really fantastic. And that was 17 years ago now, and we managed $6+ billion, or we did yesterday.
It's an amazing story of entrepreneurship and resilience. Not to date both of us, because I lie about my age constantly.
I don't, though.
But we've been through 9 or 10 bear markets. At least the ones that I can totally visibly remember. And we're certainly in a bear market right now. And so how do you weather bear markets? What's your advice on weathering bear markets? And give us a few minutes on the macroeconomic backdrop that we're seeing.
Well, we couldn't have picked a better day for explaining to people how you weather difficult markets, because a day like today where we saw panic, I mean literal panic when the number came out, and it was 20 basis points above what the whisper number was, and the market freaked out. And the job for advisors is to stay calm, to stay in the moment and understand that we own different types of portfolios and allocations because they make sense. They make sense for the market and for the client, and not to suddenly react impulsively to what the market is doing that moment and that day. I mean, the NASDAQ down over 5%, the S&P down 4%. How do you respond to that immediately? You can't. So we have to think carefully about how we allocate, and then feel confident enough in what we're doing and our approach and our strategy to stay with it and not have a total meltdown because of what the market does on any day.
Okay, so 10+ bear markets, you've figured out that when the panic goes off inside your brain, it's probably a good buying opportunity. It's worth trying to ride through the panic and not overreact to incremental market sentiment. But why is the market so shocked about inflation data at this point in the cycle, and why was the market set up to decline 5 or 8% today, depending on the indexes?
Yeah, so that's the perfect question to ask, and it feels to me as if the market has been poised to vacillate within a trading range. I'd say it's around 3650 on one side, the S&P, and 4300 or 4400 on the upside. And these are the ranges between the June low and the August high. And all of this sort of back and forth, and it's a bit like a ping pong ball. You can move, and we did move, down 10% recently, up 5.2% as of yesterday. Now we're down 4%. And the market wants clarity about inflation and where interest rates are going. For the reason that many investors in the market today have never seen interest rates at this level. They've never seen the sort of 2-year at 3.75. They are used to 0% interest rates. And I'm not talking about everyone in this room, but there are many people who are too young to remember high interest rates or high inflation. So this is scaring them. And I think that sort of creates the panic that they haven't seen it before.
So are we oversold? Are we fairly valued? Is the sell-off minor and there's more to go? How do you look at the world right now?
When the market was trading at about 16 times forward earnings, and that was in June, in the middle of June, we thought the market was very inexpensive. And the market traded up traded up 17% on the S&P, 22% on the NASDAQ, and that seemed a little rich. Now it went from 16 to 18 times. And right now, I would say I would say reasonably valued, not cheap, because earnings estimates are coming down. What we know is that there's right now an alternative to owning equities or even owning other types of anything, because if you have cash, you can get 3% on a 6-month treasury. You can make some money, just absolute money, we're not talking about relative, but you can make money in very safe treasuries and very defensive positioning. So the market didn't have any competition until recently, and it does right now. So you have to think about that.
And so your current view of growth. Obviously, growth had a big run when the pandemic started and the Fed started cutting rates. Yeah. But now Fed raising rates has frankly crushed growth. So what do you think happened? Do you think that the growth stocks will catch up to the new environment, or do you think they're going to go sideways for a while?
So they've already gone down 25 to 80%, depending on what we're talking about. You know, if you're talking about Google, for example, or Amazon, you know, you're in the down 25 to down 35% over the last year or so. I mean, Facebook, Meta is down 60% this year, or maybe it's down 65%.
Closer to 65.
Yeah. Is that oversold? Yeah. These stocks are probably washed out. Does that mean they're going to start to go up? I don't think that they have to go up imminently, but if you compare their growth rates and their potential over the next couple of years with Coke or Procter & Gamble or Pepsi, where, you know, good solid company with dividends, but they're selling for 25 times earnings, and that's more than Google's selling for sure. It's selling for, 19 times. So I think you have to look at relative attractiveness, and some of the growth stocks now are already pricing in very bad recessions and expectations of weakness in their earnings.
All right, so I'm going to try to illustrate something with my 2 question cards. Okay, see if I can do this for you. So Mike Novogratz said to me yesterday after our meeting, he said, okay, so the market was going like this.
Yeah.
And then the Fed decided to induct a tremendous amount of liquidity into the marketplace during the COVID-19 pandemic. So the trend line should have been like this, but it's not. It ended up going like this.
Yes.
And now it's got to come back down to the trend line. In his opinion, excuse me as I drop my cards.
It's got more to go.
We're not quite there.
Yeah.
That's what he said, and you just said to me, there's more to go.
Yeah,
right?
I mean, I think it depends what you're talking about. I believe that what the Fed and what the Treasury did is they created a huge amount of demand.
But laced
right?
into the question is, did the Fed make a mistake? Has the Fed made a mistake in policy in terms of the way they handle things?
You know, I'm not smart enough to judge the Fed and what drove them to the decisions they make. What I do know is that because of COVID and the effect it was having on the world, there was a huge amount of liquidity and just, surplus assets that got handed around to hundreds of millions of people around the world, and they spent that money, and that created excess demand for product. It created so much demand, it caused, I would say, an overbuying of all kinds of assets.
Inflation, supply-inducted inflation. We now have, the thing that scares me the most is we now have real wage growth.
Correct.
And so we know from classical economics that real wage growth does create levels of inflation that have to be tamped down. So we've had words used, transitory inflation, and we've had systemic inflation, meaning we're entering into potentially a decade worth of inflation. On the spectrum of inflation, based on your economic analysis, where do you think we are?
Yeah, I think that inflation for this cycle has probably peaked. That doesn't mean that we're going to be at 4% soon. We saw today that we're at 8.3%. That's pretty high. Do we think that over the next 6 months that inflation can come down fairly dramatically? We still believe that's possible because we're starting to choke off demand. You're beginning to see an effect on the housing market. There wasn't.
We're going into a recession then.
I think so. I think we're either in a recession or we're going to be in a recession soon because that's what the Fed has to do. And the slowdown we're seeing with earnings being cut, that to me spells a recession. It doesn't mean the market has to keep going down. Remember, it has gone down 20% already this year. Can it go down another 10%? Yes, but that's half of what it's gone down already. So we think in some areas of the market, it's fully priced in, but some other areas, the really high-priced, 20 times sales companies, that's still questionable about whether they've got more to go down.
So this year has been the year of the U.S. dollar. If you look at the U.S. dollar index relative to other currencies and in general, it obviously makes sense because the Fed has been in a rate-raising hawkish mode. When does that end? Does it end, or does that perpetuate for some time to come?
Yeah, so it's very hard to predict what happens to the dollar. And what we know is that the dollar being this high has a detrimental effect on emerging markets and also Europe because they're big trading partners. And they also buy their energy in dollars. So it's going to be a real negative this year. It's going to hurt earnings. It's going to cause Europe to be in a worse recession than we're in. And usually when that happens over a period of a couple of years, the dollar starts to weaken. I mean, it's just sort of a cycle. There'll be less demand for dollars, and interest rates around the rest of the world will go up, and that will kind of restore other currencies.
So we're on a, in my opinion, again, for what it's worth, we're on a little bit of a COVID-19 roller coaster.
Correct.
The Fed got scared. They inducted a lot of liquidity, 42% increase in the the M2 money supply. They're now tightening, so we're roller coastering now back. Mm-hmm. Do you change your investment philosophy during this, or do you say, okay, here's the portfolio I put in place. Its price currently I'm not focused on, I'm more focused on a 3 to 5 year horizon, or do you make adjustments pursuant to the near-term economic conditions?
Yeah, I mean, I'd say we do both. We sold, a month and a half ago, a number of positions that had outperformed the market. We felt very good. Really great companies like United Healthcare, which had done, beautifully, a couple of other healthcare stocks. Thermo Fisher, they just got to be a little pricey, and we have a little more money on the sidelines. I think that we'll probably put some money to work over the next couple of weeks, see what happens. Might even buy some growth stocks that have performed horribly because we see opportunities, but you can't keep changing your approach week to week. What you have to do is understand, as I said, that we now have interest rates at a point where the money that's sitting there in a money market even earns enough money to at least pay attention to. It's, if you get 2+% in a money market and 3.5% to 4% otherwise, I think that's something that has to be considered.
Okay, we're going to role play.
Yeah.
Right. I'm a client.
Yeah.
And I'm absolutely panicked.
Yeah.
The market's down, my portfolio's down, and for whatever reason, my portfolio is a long-only portfolio with you, so you really haven't hedged it. And let's say you're doing better than the indexes, but you're still down 18 to 20%.
Correct. Yep.
And so I'm calling you panicked.
Yeah.
And I say, what do I want to do? I want to get everything into cash because I don't want to lose my life savings. And you say what? Be my therapist.
Yeah. So, Anthony, what I would say to you is
should I lay down on the rug?
you can do whatever you want.
Okay, good. Be my therapist.
I said, we've had a relationship over years where the market has done well, and you've prospered from that. Currently, we're having the type of year that we had in 2008/9. If you were with us then, there's been, we've had some cycles over the 17 years at Aureus, and we've come through them well. What we know is that you're allocated, let's say it's 60% to equities, 10% to cash and something safe, and 30% to other asset classes, including, real estate or some privates or Anthony's funds, and there are ways that we're hedged around the equity markets, so we have to stay the course. It's worked in the past, and this will right itself again, and we spend the time and energy on your portfolio and what you need from the portfolio for your lifestyle so that you're going to be fine. You just have to stop looking at the screen every minute of the day.
Okay, let me push back, okay?
Yeah.
But I don't believe you, Kari. I'm super nervous.
I hear that. Yeah, I hear
Why
that.
won't the market just trade to zero on me and wipe out my account.
Yeah, well, I would tell you, which is something I tell people, that those people who trade when they sell low and buy high always make less money than any other investors in any fund.
Right.
Right.
I mean, we both know that the dead people at Charles Schwab do better than the living, right?
Yeah,
We both know
exactly.
that, right? Because the dead people don't look at their portfolios.
They don't move around.
They don't move the portfolio.
Yeah.
So your messaging is to be a long-term investor. You mentioned Peter Lynch. You work for Peter Lynch, legendary investor, 30 plus years ago, wrote a great book called One Up on Wall Street.
Yeah, that's
which
right.
is an introduction to Wall Street for many of us. Tell us something about Peter Lynch and your early career experience with him that you've taken with you into your career.
Yeah, so I think about what Peter taught me all the time, and the most important would be you need to understand for whatever, I'll talk about stocks because that's what Peter talked about, whatever stock you own, there is something that the market doesn't appreciate about it that will be priced higher eventually because of what you have learned. You spent the time and energy to examine the company and do the research. And if it's undervalued because the market doesn't yet appreciate it, but you know that, then you've made the right decision and you should stick with it. And eventually, the market will prove you to be right. And so I think about that.
So these are businesses, and you're analyzing these businesses on a number of different metrics. It's not just pieces of paper or electronic digits on a screen.
Yeah, that's right.
Actually looking at the enterprise value of an existing business. And we both know that the fickleness of the market can create opportunity.
Yep.
Opportunity to buy, or the market's too exuberant and you've got a situation where you have an opportunity to sell.
That's right.
But the best strategy is to stay the course. Am I right?
Yeah,
What did
I
miss?
think right now, I mean, that's what you can't panic and you can't sort of let your emotions carry you away because that will bound to be a mistake.
All right, ladies and gentlemen, the art of intelligent investing, Kari Firestone. Thank you very much. You were terrific.
Thank you. Yeah.
Great. That was awesome.